I would like to welcome everyone once again to our fourth lesson in the course, Market Profile Beyond the Basics. Please forgive my hoarse voice today. I'm a little congested and I have a cold, but hopefully everything will be coherent and you'll be able to understand everything that we will go over. As usual, before we begin, we need to review together the disclaimer. Trading and investing involves high levels of risk. Future results can be dramatically different from the opinions expressed in this course. Past performance does not guarantee future performance. The presenter may or may not hold positions in the financial instruments discussed. In our fourth lesson, we are going to be looking at analyzing volume using footprint charts. In the previous lesson, we began by introducing the footprint charts and explaining what they are and some of the formats that we can use to display data in these footprint charts. And as I mentioned in the previous lesson, there's a lot to these charts, and so we are today going to be looking at analyzing volume using footprint charts. We're going to begin analyzing volume using an indicator that I developed known as the Kepler volume tracker, and we're also going to look at volume filters, and we will be looking at volume imbalance. So let's begin by taking a look at the Kepler volume tracker, or the KVT as it's commonly known. First of all, let me talk a little bit about the concept of the KVT. The idea is that it is very important to recognize and identify intense, heavy volume activity in the market. And the reason is volume is the fuel that generates market moves. To get a move and to sustain it, a directional move, you need to have volume behind that move to keep it going. Now, why large volume? Certainly, small individual participants in the market do not have the wherewithal to create market moves. Even though they may think that they are wealthy relative to the market, they're still a somewhat of a very small participant in the market. Large volume means significant capital. So for someone or a group of participants to come in with heavy volume, it means that they have a large amount of capital behind that volume. So significant capital in turn means smart money. Now, most traders have come across or have heard the term smart money. Smart money is really a term that's often used to describe major market participants, be they large institutional funds, be they banking interests, be they market makers, but they are significant entities with significant amounts of capital, and they have the wherewithal to move the market. Now, as a result of them having this capital, that alone, having capital, doesn't make them smart, but it's the resources that are available to them and the information that's available to them upon which they act. That is what is often significant and is not available to other smaller participants in the market. And that's why, in being able to identify this heavy volume participation, we are in essence able to identify smart money. Now, smart money also tries to conceal its movement within the market. That's part of the reason why they're also smart. They don't want to make it readily available or easily known what their plans are for the market, so they do use a number of different smart strategies to trade. Rarely will they come in and plop down just a huge amount of sum and then walk away. What they will do is they'll disperse their purchasing over a period of time at different price levels, and we are able to detect and track these movements in the market through the use of the Kepler volume tracker. So that's the concept. The concept is we want to really be able to identify the elephant in the room, the elephant being smart money, large participants, and therefore we needed a tool that would help us to do that. And I developed the Kepler volume tracker, which is really an algorithm that takes a look at volume and helps to identify for me different levels of intensity when it comes to volume. And we'll talk a little bit more about what the Kepler indicator or the Kepler tracker does. First of all, the objective of the tracker is to identify the presence of above average volume. Now, let me tell you a little bit more about the algorithm for the Kepler volume tracker. It only works on time-based charts. So it cannot be placed on a tick chart or a volume-based chart, but it will work on any time frame. And the reason is, in my logic in developing the tracker, I thought that I didn't want to just identify large segments or large parcels of volume at any particular time. I wanted to look at, in this same specific period, over a period of time, if we were to go back and take a look at the average for this specific period, is this volume really an anomaly? Is it much greater than the average? Now, in addition to being able to detect and identify the presence of above average volume, I also wanted to classify the extent of the increase above average. I have one standard deviation and two standard deviations above the average. So I didn't want to just say, okay, I've got lots of volume here. I wanted to be able to know, well, to what extent is that increase? And that gives me an idea about the intensity of participants in the market and their commitment to a specific direction or move. So the KVT will identify the presence of above average volume. It also will classify it for us into two different levels of intensity, what we will see as level 1 and level 2. And in addition to that, once we place the tracker on the chart, it allows us to track the price levels, where they are on the chart, that have the heavy market participation. And in doing so, we can monitor the relevant market activity of those major participants in the market. The KVT is easily obtained. It comes as part and parcel to the Market Delta platform. It is also available as part and parcel of Investor RT. And so all you have to do is pull up the indicators and choose the multiple price highlighter. That is the indicator that includes the KVT. And incidentally, after developing the KVT, they also added a number of other interesting features in terms of volume filters that we will also look at and use because they are helpful. Volume is, again, you will see, is a very, very important variable in the market, and it behooves us to keep our eyes on it. So once you choose the multiple price highlighter, once you choose that indicator, you want to select the Kepler volume tracker out of the different options that you are going to highlight here. And once you've selected that, now you need to come in and put in the settings. Now, these settings will vary from one instrument to the other, and typically it'll either be 10, 20, 30, 40, or 50. In this case, these settings that we have are for the ES Mini. And again, the setting for level 1 is a 20, and you will see that the setting for level 2 is 30 right here. So now we have, once volume is detected above average for level 1, we are going to show one standard deviation away from average, and level 2, two standard deviations away from average. The next and third most critical setting that you need to put in here is the number of days you're going to back test for. Remember, this is how the Kepler volume tracker works. It takes a look at a specific period of time. Let's say the first half hour of the day. And now, if you put 50 days, it is going to go back 50 days and take a look at the average traded volume during each of those 50 days during the first 30 minutes of the day. So take a look at the accuracy of it. And then it is going to look at that average, and it is going to compare volume at different price levels within the current period for today, or the day that you're looking at, relative to the average of the 50 days. The minute it identifies some volume that is significantly above average, one standard deviation above average, or two standard deviations above the average, it will immediately give you an indicator, or it will give you a visual symbol on the chart, and I'll show you in a moment what those can look like. But that is the idea of the KVT. In this case, the marker that I am using, the identification marker, is a little dot, and sliced into 4, offset by 1. And those are all settings that you could vary, but I just want to go over them so you can do it on your own later. Now, typically I choose different colors for each of the level 1. Here's the color for level 1. For level 2, here's the color for level 2. And usually what I try to do is use a light color for level 1 and a darker color for level 2 to indicate the greater intensity. So visually it is easy for me to pick up on that quickly on the chart with just a quick glance. Alright, so now we have a 30-minute footprint chart with KVT markers. Now, with the footprint, it is a little bit noisy, so it may seem a little difficult to track where they are. So what I've done is I've highlighted them for you. And again, here I'm using a 50-day back lookup period. So the tracker is going back. So for this period, when we went back 50 days for this same period, which was really, if we look at the time here, at 8 o'clock, from 8 o'clock to 8:30, for the past 50 days during this same period, in this one level, in this one price level, we had a variation in volume that was one standard deviation above the average at this specific price level. Same thing here, same thing here, same thing here, and the same thing here. So this is typically how the markers will look. Of course, you can change the visual for that. This is what typically I will use. Now notice the only one here that we had that showed significant volume or two standard deviations above the average was this particular level right here. Now, I want to draw your attention to the fact that if you just quickly look at where the volume levels are, that in itself tells you something right away. Take a look at here and what happened to prices. Shot up. So obviously this was buying volume. Now, we take a look up here and we start to drop below this level. And we're at the same level here, and we dropped again. And then we start to see prices hit back up again. This was an area of congestion. So obviously neither the buyers nor sellers were dominant in this area of congestion. You could see it, the up and down vacillation. You also see sort of the 20 simple moving average. The red is the 50, the 20 and the 50 coming together. And also the simple 5 average doesn't really know which way it wants to go. This is all very typical of congestion or a sideways market. So even though I do have some intense volume here, it never really gave a clear or coherent direction in terms of buying or selling. Now here, when we had that double intensity, prices shot up, so it indicated that at least this was buying pressure, or these were bullish transactions during this particular period, and it did take prices back up higher again. And if you notice here too, these three KVT markers that appear are all above the 20, so the 20 seemed to be holding, and until we came here, and then it started pushing back up again. These are just some basic observations. We will be looking at actual specific setups using the KVT and the power of the KVT. Now, I wanted to change the lookup period to 20 days instead of 50, and I wanted to show you how that significantly impacts the number of trackers, or the price levels that are identified. In this case, we only had two. One here of two levels, one on top of the other, and another one, the same one we had back here. So you can see that there is a significant difference, and the time setting is a very important one in the KVT. The more days you have, and by the way, you don't want more than 50. 50 is a good number. The more days, the more representative the average is over a period of the more days we have, and the more averages in the calculation, the more streamlined the numbers, and probably the more accurate and the better we are able to detect our level 1s and our level 2s. Now we're going to take a look together at a trade setup using the KVT, and I've tried to magnify it here a little bit. You have a lot of lines from the different profiles, but I'm using the KVT indicator on the candlestick chart, and let me show you what the setup will look like. And it's a very good high probability setup. Well, for starters, we're going to focus our attention on these two candlesticks, or these two 30-minute periods, and they are, for this particular session, they were the very first two 30-minute periods during the session, or in other words, this was the initial balance. Now, if you take a look during the actual first 30-minute period, during this 30-minute candle here, we didn't get any KVT. KVT started to show up. Here's level 1, here's level 2, here's level 1, and here's level 1 again in the following, or in the second half of the first hour. And notice what happened when the KVT started to appear. We actually did not drop below the low, and we did not go above the high, so we ended up with an inside candle. And that's not uncommon. This pattern actually happens fairly often, and what's happening is really the market is trying, if you take it from a pure candlestick standpoint, it's really saying the market is confused, the market does not have a clear direction, one candle is inside the other, and we just really don't know where we're going. And here's where the KVT comes into play and really eliminates this ambiguity, because we are going to determine the direction based on heavy participation, based on the large volume that actually was traded during this initial hour. So let's take a look at the parameters of this 30-minute setup. The first thing that we want is, once we have the KVT indicators on our 30-minute candle, we want to make sure that we close above KVT levels. So even though we may have some up here, but at least there were some below. And we ended up closing above the levels below, and in this case we actually had more below than we had up above. If we didn't have any below and they were all above here, and we end up closing lower, then obviously that was selling activity. In this case, what this is telling me, because we ended up closing higher, is that this heavy volume participation was buying activity and managed to push prices higher for a close above the open. This may have been selling, but it still was not enough to overcome the buying pressure down here. After all, here we have 3 different levels that we've identified, 2 level 1s and 1 level 2. Here we only have a single level 1. So we want to make sure that we get a close above the bulk of our KVT activity. And we have that in this case. Now let's continue on and take a look at the other parameters involved with this setup. The next thing we want to look at is we want to make sure that the close for the 30-minute candle is above the 5 simple moving average. And here is the 5 simple moving average, and I do in fact close above it. So I've got 2 of the key parameters. Anytime you encounter this setup, and I'll tell you it does happen frequently in the market, you should be getting ready to go for long. But don't rely just on those 2 parameters. There are a couple of more pieces of evidence that you want to have behind you, or you want to have on your side. And let's take a look and see what they are. So in addition to the close above the 5, you want the 5 simple average to be pointing up. You don't want it to be horizontal. You want it to be pointing up, as is the case here. That's the direction that I want. So I close above it, and it's pointing up or pointing higher. Now, in addition to that, there's also another helpful parameter. I want my 5 simple moving average to be above my 20 simple moving average. Look at where the 20 is. It's right here. And sure enough, my 5 is above it. So far, all 4 conditions that we have identified are present and accounted for. As I have all the conditions in place, my level of confidence begins to increase, and I know that this is going to be a high probability entry. I closed above my intense KVT activity. I'm closing above the simple 5 moving average. The simple moving the 5 simple moving average is pointing up higher, and the 5 simple moving average is above the 20 simple moving average. Now, there's one more item that we need, and that's a very important one. Prices need to move higher than the KVT high of the prior bar. Now let me explain what this is. This was the highest KVT level on this bar. Okay? What I want for assurance, not necessarily that I'm going to make a higher high up here, I want to make sure that when this bar opens, that prices continue to push and push higher than this highest KVT on the bar. If that's the case, and this happens the minute prices are above that level, then I am ready to take my long, and prices usually will fluctuate. You could probably grab it at a decent price somewhere right at the KVT high, maybe a tick or 2 below it. It'll vary, but as prices fluctuate, you know now with this setup in place that this is a very high probability long, and you should feel comfortable in entering a long trade based on those parameters. Now, if you go ahead and decide to take a long, so you enter a long at sometime at the open here or above the open, once prices take out the high of this KVT, you want to take a long here when this candle opens. So the next is always our most critical element, and that is our risk management. Where would I exit this trade if things go sour on me? And you should always plan for that. Even though this is a high probability setup and there is a good probability the trade will succeed and I'll be able to get something out of it, nevertheless, I should always have my exit strategy planned in advance of any trade. In this case, the stop loss simply, again, I'm going to use the KVT, and here I will use the lowest level of KVT on this bar. And the nice thing about this, if I enter somewhere up here, somewhere between this area right here around the high KVT, my exposure is somewhat limited. I'm not waiting for the low of the bar. I'm actually relying on the intense volume activity to give me my cues. Now, why would this make sense? Well, if these participants are in fact powerful players and they're going to push prices higher, certainly if prices came back here, they are going to push them right back up. And if they don't protect the territory that they've carved out for themselves and prices continue to fall, I want out of that trade. The commitment just was not there. And if that's the case, certainly take my loss and wait for another opportunity. However, given the confluence of evidence and the various items that we've discussed on the previous slides, things should pan out for you. The next important thing that we want to be thinking about, in addition to risk management, are our targets. Where should we have a reasonable target? Will this go on and on forever, or when do we exit the trade with whatever profit is reasonable for us? My first target would be whenever I'm taking a trade early on in the day after the first hour, and the first hour sort of had a limited initial balance, as was the case here, the value area high of the prior session. So I would look to see where the value area high of the prior session was, and I believe it was somewhere around here. That was the prior area high. And then the next target would be the high of the prior session, the actual high of the prior session. You should always sort of conservatively space out your targets and allow yourself to capture as much profit as you can as quickly as possible. Maybe enter the trade again at another point, but always try to capture, especially if you're trading intraday, as much of the gain as possible at reasonable points based on the profile. Now, I want to continue on with the KVT and show you how it will help us to also manage the trade. So let's take a look at the progression of this trade as it continues to develop. And you notice here, this is where we started. We came into the trade here, and we've taken some off at different periods here. Now notice, we get another intense level 2 KVT here, continues higher again up here, and prices continue to move above it, so obviously this was additional buying activity. Now when we get up to this level here, we begin to see negative pressure, and prices start to drop. And they drop all the way down to here. Notice how close that is to where the prior intense activity was. Then during this period, I begin to see some additional participation come into the market with intense volume. And what happens, when would I go long here if that takes place? Again, once prices exceed the high of this KVT level in this next candle. So up here I would be willing to enter, and notice I get another KVT, pushes prices higher, so obviously this is buying activity that's continuing. In this case, I end up with level 2 KVT activity here, but look at the outcome of what happens after it. Prices drop, so obviously this was selling activity. Now it drops, and notice it comes right back to this level where the buyers were. Folks, this is not coincidence. We're tracking the footsteps of the giants. They were here before, and now they were willing to buy. That's what stopped prices from continuing lower here. We do see a little bit of a drop, but notice at this level we begin to see heavy participation again. And when this heavy participation again comes in, prices are able to navigate higher, push higher. We get even more activity up here, more intensity. And notice, with this intensity, we begin only to see prices hit higher after a drop back. You will often see that happen in the market very frequently, sort of to shake participants out. After a big red candle here, many will have had the idea that perhaps the move up has ended, and they will take shorts, and this would be a great way to entice more shorts in and then to trap them and actually use them as they cover to hit and propel prices up above and push prices higher. The important thing that I want to bring to your attention is how these KVT levels become significant inflection points. They're points of change. Notice here when they occurred here, and it brought prices back up again. When we came back to this level for a retest, it managed to bring prices higher again. Here we continue to move higher. Once again, here we were able to pierce and we dropped through, but back again, this buyer here was still here and lifted prices higher yet. And once again, the last KVT level that we have is up here. Now, notice also the relationship of where these high volume activity price levels are occurring. Are the majority of them above the simple 5 moving average, or are they starting to occur below the simple moving average? When I begin to see negative or red candles moving lower, and then if I start to begin to see volume below the simple moving average, that's an indication that perhaps direction is going to change and we are going to see prices continue to drop. It is interesting how they move in the direction of the moving average. Keep an eye on that, and as long as you continue to see the intensity or the intense levels of volume above your simple 5, you are probably in safe bullish territory for that period of time. The minute you begin to see a change in the opposite direction, then certainly act and behave accordingly. It may not necessarily mean a reversal, but at minimum it is probably going to be a retrace. That is how helpful the KVT is, and that's how we use it in our trading. We can actually create setups based on that. Once you understand the basic premise of the KVT and the importance of tracking and identifying the price levels where the heavy hitters participated, how that can help us to stay on the right side of the market and keep our trades more in the profit zone rather than trading against the market or against the big money. All right, we're now going to switch gears and start to look at another tool to help us analyze volume. We've been looking at the KVT, and now we're going to use the same indicator that helped us to set up the KVT to set up a volume filter. And we'll be looking at using the two together or in combination. The volume filter conceptually is very different from the KVT. When I explained the KVT, I mentioned that it had a look-back period, and it would go back, calculate the average for a certain number of days, and then determine whether volume was 1 standard deviation above the average, or if it was 2 standard deviations above the average. A filter, on the other hand, simply looks at a finite or a fixed volume level. It looks at each price level and calculates, is this amount equal to, less than, or greater than? And you can identify any volume parameter you want. It could be greater than, less than, equal to. It's all up to you with the filter. It's very precise, but it doesn't do any kind of back period testing or any kind of comparison. Again, the filter is meaningful relative to the instrument that we're trading, and of course the settings will vary from one instrument to the next. In this case, we're still looking at the ES Mini, and so I have set the filter to 8,000. So every time we have volume that's above X, with an X 8,000, the software or the platform will highlight for us that price level. Similar to the way that I identified the KVT tracker, I still like to use the dot, and except this time I'm going to use different color codes so I can distinguish between whether it is volume filter or KVT. But again, the same principle I use or apply again, and that is I use a lighter color and a darker color. Here, the darker color is intended really to show a negative delta for the number. In either event, I'm really not concerned whether it's negative or positive. I simply want to identify the volume at that level. So for all intensive purposes, if you wanted to use the same color for both, that would be fine. There would be no problems with that because we're really interested in identifying the volume level. We haven't yet discussed anything about the delta, and at this point we are only focused and interested in volume and total volume at a price level within a specific period in time. So let's see here. We move on to this slide, and on this slide I have both indicators on the slide, a volume filter and the KVT. Now it does start to look a little bit noisy. Let me share with you what all these different little dots are telling us. Alright, so from the KVT indicator before, we had the light green and the dark green, and we still have them on this chart. You can see here some dark green above the light green, and these are KVT markers. In addition to that, we also have some tiny blue dots on the left-hand side of the column, and each of these price levels now is 8,000 plus in terms of volume. So it begins to present a really interesting picture, and I want you to note how there are times when the period will include significant volume, but it'll be spread throughout the bar. The only intense volume will be identified, or the intense level, and in this case we even have a red dot because I've added another filter, 15,000 and more. But notice how there are a lot of these little blue dots which indicate the filter 8,000 plus in terms of volume. We continue with it again, and again that is heavy participation, and it's continuing in the market. But you begin to see the distinction. The filter, you tend to get a lot of points like that. The KVT, on the other hand, you get fewer points. It's more specific to certain price levels because it really is doing a very different calculation from the filter. It isn't just looking at a specific number. It's doing a periodic backtest and comparing relative to this same period in time at this period in time relative to other periods in time on prior days. So we're looking at apples and apples. In the case of the 8,000, it really doesn't matter. Wherever it appears, it is going to plant one of these little blue dots for us. Or in the case where we're going to have 15,000 plus, we are going to get a red mark. And this is a significant level when you get 15,000 plus at a price. Notice it's got my KVT, it's got the 8 plus the 15. And naturally it would also have the 8 because 15 is greater than 8. So I have two different filters on this chart. And yes, you can put as many different filters as you want on the chart. Just make sure that you remember what the color codes are and be able to identify what is what. You don't want to put too much to whereby it gets too noisy, but you have the flexibility to add whatever number of filters you wish to have. All right, now this volume here that we've identified with the heavy volume, I want you to recognize that this is going to be even in the future, a significant level of support for us. Why support and not resistance? Because take a look at what happened when this intensive volume came into the market that was greater than the 15,000 and also a whole bunch of 8,000s here. Obviously, this was predominantly buying activity, or in other words, there was great demand in this area that pushed prices higher. And we know that because we can see the outcome. So even after the fact, when I see that and I'm able to identify these key price levels on the chart, I can put a line on my chart and signify that here was some heavy intensive buying activity. Again, the footprint of the giant. And this particular giant was buying here. So if we ever come back to revisit this level, I have to look at it, and I always look back and see, are we going to find the same behavior reoccur, or have things changed in the market? If this buyer is still committed, then I am likely to see the same impact again, and prices will start to go up if we come back and visit this level. If not, if this buyer has decided that they're no longer interested, that will not be the case. But nevertheless, if I've highlighted that level on my chart, I know that I should be more attentive to the market or to price reaction when price moves and navigates towards this price level again at a future or later date. All right, so you can now hopefully see the difference between the filter and the KVT conceptually, and you can see that the KVT is a different perspective altogether from a volume filter. The volume filter simply just detects certain volume levels. It doesn't look back, it doesn't analyze intensity. You can gauge the intensity simply by adjusting the filter to different volume levels. So you can use either or in fact you can use both together on the chart. All right. The last analytical tool that we are going to be looking at together in this lesson is the volume imbalance. And this is also another feature of the footprint chart, and a very valuable and important one at that. Let me begin first by explaining the idea of what volume imbalance is, and then we'll take a look at how we can detect it on a chart and why it's useful for us to identify these volume imbalances. When there is a volume imbalance, it means that either it could be in favor of the buyers, or it could be in favor of the sellers. So if the imbalance is in favor of the buyers, then obviously that is going to propel prices higher. If in fact the imbalance is in favor of the sellers, then naturally prices are going to drop. In many ways, looking at the volume imbalance is a much smarter way to look at the market than just looking at the bid and ask levels. And let me share with you why that's the case. At the very beginning, on the onset, we have to set up what imbalance we're going to look at or look for. So to set up the imbalance, when we get the instrument window, and of course we will choose the time frame that for our chart. In this case, we're still looking at a 30-minute chart, but it's the same window. It'll have the 30 minutes there. And then you select the footprint type, which will be volume imbalance up here. That's the footprint type. You can change text color and some of these other features. They're insignificant. The most important thing is the selection of the volume imbalance. The next most important thing is shading. Down here, this is the calculation that determines the level of imbalance that you're looking for. If you choose automatic, the default for the software is 140% imbalance. Now, sometimes 140% is a little too high. I tend to want to look at imbalances at least 130%, at around 130%. So what I do is I click on the manual button here, and then level 1 I put 130, and that will give me the 130% I want. You could adjust it to whatever other percent you want. That has to do with, again, personal preferences and styles of trading. But I find I want to see even an imbalance that's 30% off. I don't want to leave the threshold as high as 40%. Certainly, the greater the imbalance, the more powerful it is in terms of the impact on price movement. But I still want to see the frequency. Do I have more in favor of the upside, even though they may be lighter or less intense, or do I have more in favor of the supply side, or the negative, or the sellers in the market? So that is the basic idea behind the imbalance. We look at variations in percentages between the volume at the bid and the ask. However, this is something very important that I want to highlight for you. We do not look at it in terms of the same price level. We look at it diagonally. Well, we know that all the prices on the left are the bid, all the transactions, the cumulative volume that transacted at the bid, and all the prices on the right are the cumulative transactions at the ask. But when you observe how the market works, the market is always looking at the bid down here and the ask above it, not the ask right at the same level. So it looks at the ask diagonally from it. Let's take a look at an example together, and this will make it much clearer. Okay, if we take a look at this candle here, and we want to examine the volume imbalance in this candle. First of all, the first thing I want to look at is there any imbalance? Sometimes there will be, sometimes there won't. If there's no imbalance, I'm going to see very few reds and greens and more blacks in the bar. That's more of a neutral situation where the imbalance is not very apparent in the market or during this particular period. Now, in this case, just a cursory look, if you take a quick look, you will see that we probably have a few more on the red side than we do on the than we do green. So there is an imbalance on the bid side, if you will. And here's how we're looking at it. If you take a look here at this particular period, at the very top it says 0 and 18. The next level, 71.32. The level after that, 105 and 301. And then 560 and 367. What we're doing to determine the imbalance is comparing 71 and 18, this level. We're comparing 105 to 32, and we're comparing 560 to 301, and so on for every other price level in this bar. So if we go all the way to the bottom, it says 48.0, and the price above that I would compare the 48 to would be 51. And if you notice, 48 and 51 are really the same color because there's no imbalance. Remember, I told you the setting for my imbalance for this chart was 130%. But if you notice, there isn't a 30% imbalance between those two numbers. 48 and 51 are very close. The only difference between those two numbers, basically, if you subtract 51 from 48, you get 3. And 3 is a very small percentage out of 48. If we did the math, it would come up to about 6%. So there is no imbalance there, and that's why you see it on the chart. Both of them have a black color. However, when we begin to look at the following number, the 661 and the 427 right above it, here we have a more significant variation between 427 and the 661, and therefore, and the variation is, the imbalance is in favor of the bid side, and that's why it is in red. Similarly here, at the top of the candle, or the top of this period, 018, 7132, 105, 301, 563, 67, if we take a look at these numbers, we will find that all the red numbers, in fact, are at least 30% or more greater than the numbers above or that were at the ask. Let's do the calculation together here just to demonstrate how we arrive at that percentage. And I'm doing it here for the example that we show. And remember, we're looking at the candle right here, this one here, and in this case we are looking at 105 and 32. Notice we look diagonally. 32 is the ask and 105 is the bid. Now, we subtract 32 from 105, we get 73, and then we divide 73 by 105, it gives us 0.69. If we multiply 0.69 times 100 to get a percentage, 69%. So the imbalance, or the extent of the imbalance here, is I have 1.69, or 169% of the imbalance is on the bid side. So the pressure is to the downside. And I tend to see that continue as we drop. But if we get to one point here, you will see that I have 839 to 1308. And that is another significant variation, but this one is to the upside. So even though I have more red here, down here, when we got down here, I begin to see strong imbalance to the upside. Now, we don't look at these numbers in a vacuum. We really, first of all, need to understand what the imbalance is, and then when we look at them in context, relative to our profile lines or relative to points where we are anticipating or expecting some sort of change in the market, these levels begin to take on a new significance and have new meaning. So here's how we would begin our analysis of the imbalance that we see. First of all, between this bar and this bar, these two bars down here at the bottom, this one and this one, is there a change in the nature of the imbalance? Meaning, did one have more reds and then the other one now started to have more greens? And the answer is yes. So now we need to be attentive to what's going on because the balance has changed. In addition to that, look at what happened when this balance changed. Once we closed, we had a higher low and a higher high. So it tells me that there is a change in the market to the upside, that prices are now more likely to move higher than they are to continue lower, because the imbalance was to the negative side here, but here it was overtaken to the upside, and in fact we ended up making a higher high and a higher low. So if you were trading just strictly on a candlestick pattern, this would be very helpful for you to look at the change in the volume imbalance. And by detecting and recognizing that we've had a change in the nature of imbalance to the upside, you would be far more interested in taking a long than you would be in taking a short, because you can see it right there with the numbers and the imbalance. Now, let's continue on to the next bar, the bar that follows right after this one. Do I see more imbalances on the bid side, or do I continue to see imbalances to the upside? And the answer is obvious because of the number of green number of green that I see at the different price levels, it certainly exceeds the number of red. So obviously the market is continuing to facilitate trade to the upside. If I were long in this trade, I would certainly continue to stay in it. Nothing alarming at this point. Now, I haven't talked about the KVT on the chart at all yet. Let's just stick with the imbalances for a few moments, and then I will bring in the KVT into the equation. So we're still in the trade. This is another imbalance to the upside. Let's take a look at this candle here. What's happening here? Same thing. I tend to find more green, more of an imbalance to the upside, and sure enough, prices continue to move higher. Remember, the imbalance favors the upside or the buyers anytime I have more greens. And we're comparing the bid and the ask above it, not right next to it, the one above it. Now we continue on and notice what starts to happen here. Now, I can't say that I have more red, and I can't really say that I have more green. I'm beginning to get to a point where I seem to have an area of balance. We're starting to be at par. So now, if in fact I was in a long position, this would be a time when I would begin thinking about taking my profits and exiting my position, simply by looking at the volume imbalance. This is how the volume imbalance helps me to manage my trade and to keep track of how things are progressing in the market. Now, let's take a look at the KVT, but in light of the volume imbalance. And what I want to do first is focus your attention. When we're doing our analysis on the volume imbalance, there are really two key things that we want to focus on. The first is how many imbalances in the period, how many imbalances are to the upside, relative to how many imbalances to the downside. If we have both of them about the same, then in fact we have an area of balance. We don't have a significant imbalance. Now, keep in mind though that you may end up with more green or more red, so there's another piece to this equation that you really have to keep an eye on, and that is what is the extent of the imbalance. The extent of the imbalance is very important. When you look at the numbers and you begin to compare and contrast them, for instance, when you take a look at the 1530 and the 441, that's a significant variation. But when you begin to look at 399 and the number below it here looks like maybe it's 104, so that's another significant variation. 353 and 326, not so significant. So that's what I want to look at, the extent of the imbalance. The greater the extent of the imbalance, the more power to the move, the more momentum to the buyers in this case, because the imbalance favors them. Now, the KVT adds another very interesting dimension to all this. We know that the KVT is identifying for us levels of intense volume. So these levels are crucial in the bar, and I really should take a keen interest in the extent of the imbalance on those levels. So take a look at the extent of imbalance between the 1136 and the 64. We're looking at an imbalance here of over 10 times the 64. The 640 would be 10 times. So there is really a significant imbalance here. Whereas if you look at the negative one, about 1600 to 677 at the most, that's about 3 times. Just eyeballing it, it's a little bit less. So again, not that significant in favor of the bid side. So it tells me that the buying pressure is stronger. Of course, I also see the impact that prices are moving higher and rising rather than dropping. Once again, I continue to see significant imbalance to the upside in this candle, and certainly we have more imbalances to the upside than we do. We have greens more so than we do reds. And we continue higher till we get to this area where we're starting to see some balance. Now I need your help. I want you to begin analyzing with me using the KVT what is likely to happen next. What is going to happen? We know that we had heavy participation here, and obviously it pushed prices lower because we didn't close at the high. And then we had another level here, but it didn't push prices lower yet. So we are at an area of somewhat of balance. Now look what happens here after this heavy participation, this intense volume that came in. Now prices are starting to drop lower than these price levels. Would you be in favor of taking a short or a long at this point? Let's take a look at the imbalance in the bar. 889, 643, 571, 296, all more in favor of the seller here. Heavy, intense KVT activity above it, prices dropping and dropping below the KVT activity. Well, based on our discussions earlier, certainly I would be short. Now let's take a look at what happens and continues to happen. Notice we were here at this candle. We sort of stayed in the same range for a little bit and then dropped a little bit more, dropped a little bit more. Now I want you to notice, because we talked about this before, these key levels of heavy participation. Notice I get heavy participation again. This is not by chance or by accident or a coincidence. These are the heavy players. These are the levels they're participating at, and they tend to influence the market at these levels that they come in, and that's why it behooves us to pay attention to those levels. If in fact these buyers are still buying and they're still strong, I would expect to see prices start to move a little bit higher. If in fact the sellers are far more stronger, and this has become an area of resistance, I would anticipate for prices to continue lower. But based on looking to the left of the chart and seeing KVT activity here, this was buying before. I can't help but ask the question, is this going to be buying again, or has the buyer faded from the market? Already, by virtue of the fact that I only see one level 1 rather than I had a level 1 and a level 2 there, I begin to question the commitment of the buyer at this level. Notice how we begin to integrate the different pieces of information into our trading and these different tools that we have. The more accustomed and the more you get used to them, the easier they become, and the process becomes second nature. All right, one quick thing I want to go over. Today was a rather exceptional day in terms of trading. We had a very strong trending day to the downside, and I want to show you how we could have detected that very early on in the day through the volume imbalance at the initial period during the first half hour, and the hour that followed. In this case here, we had a little bit of imbalance greens to the upside, and then we saw imbalance reds here, but it started to really show down here and far fewer greens as we started to drop lower. And now notice this candle, this is the beginning of a trend. Notice how strong that is. Nice big long candle, consistently imbalanced to the red, sporadic greens every once in a while, and the rest is history. The market took down for a nosedive, and you will see sort of the imbalance continue throughout the rest of the day as you examine the chart. So the techniques, the tools are helpful. The most important thing is to practice them and to learn to apply these concepts that we're discussing. With that, I will conclude our fourth lesson, and I'll encourage you to forward your questions and answers. I've been quite diligent about getting the answers back to you on time, so I look forward to seeing your questions and to our next lesson.